Welcome back. As promised, this is our special segment, Quarter Se Quarter Tak, and Abhishek is here today to take us through expectations from the NBFC sector and what you can look at this quarter around. Abhishek.
Well, non-banking financial companies, that is NBFCs, are expected to report a strong Q4 FY23 in terms of results, driven largely by higher disbursements and recoveries despite the potential impact of rise in interest costs or interest rates on their net interest margins. So there is a strong underlying consumption demand seen across segments of housing, vehicles and consumer durables, which is likely to support the disbursals trend for NBFCs. Housing finance companies are expected to report growth in the low to high teens with stable net interest margins, and SDFC Limited and Canfin Homes are expected to report good numbers. So commercial vehicle is the other sector which is expected to report strong growth in mid-teens, that is 15% to over 25% due to strong disbursements. Gold financiers over there, you can expect the pick up to sustain in this quarter in terms of quarter-on-quarter growth rate, with Muthoot Finance expected to report positive sequential growth, while Manappuram Finance is likely to report negative growth on a sequential basis. Consumer finance is expected to report better the growth given the fact that there is improved macro seen in Q4 with no asset quality woes expected, but there may be some pressure on the net interest margin. So according to key estimates by Antique, SDFC Limited is expected to report net interest income at about 4,929 crore, which is up 5.1% YOY and about 0.3% sequentially, and they are expecting profit of SDFC Limited to be up 1.1% YOY and about 1.4% sequentially. For Bajaj Finance, they are expecting net interest income growth of about 26.9% YOY and 3.5% quarter-on-quarter, while profits of the lender is expected to grow at more than 26% YOY and about 2.6% sequentially. For Cholamandalam, Antique is expecting net interest income growth of about 20% YOY and 1.7% sequentially, while they are expecting the bottom line growth of 0.3% YOY and about 1.1% sequentially. For Muthoot Finance, Antique is expecting net interest income growth of about 10.4% YOY and about 10.6% sequentially, while profit is expected to decline by 0.4% YOY but be up about 6.1% quarter-on-quarter. Back to you.
Okay, thanks a lot for that. Well, Nishan Chavate, who's the senior analyst at Kotak Institutional Equities, joins us now to tell us what to expect. Nishan, you heard Abhishek out. Tell us what is your, in the coverage universe that you have, which are the companies where you're expecting to see growth? What is the what is the stock price recommendation this time around?
Thanks. Generally, non-bank finance companies will report a strong quarter. If you look at the last 3-4 quarters, the overall momentum has been strong. Typically, fourth quarter is seasonally a strong quarter. So obviously, you have got both the factors working on your side. Some of the companies have already put out their, business releases. And, if you notice, they are kind of, using terms like all-time best, all-time highest. And I think that's an indication of how this quarter is going to be, not only for these pairs, but probably across, across the board. You would probably expect loan growth to accelerate further, anywhere in the range of around 30-35% for the likes of Chola, to even for some of the, for some of the smaller players to be, in the range of around 10 to 12%, which is kind of a steady acceleration. We are positive on the vehicle space per se. Chola is, has been our, favored pick. Here you can see that this is a business where you are enjoying the tailwinds from the vehicle business, plus you are adding new product lines, which is sort of helping your both growth and profitability. Mahindra Finance, at a very interesting juncture right now, a very strong year. Plus, coupled with the fact that there were certain concerns on this company if they could comply with the new RBI NPL norms, and now it is more or less clear that they are able to sort of do that. So you should probably see momentum remaining strong here as well. And Shriram Transport is again the company has just kind of completed a merger. And I think on that base, market is not expecting any synergies, expecting business performance to be flattish. And our sense is that, given the way the macro is, probably you would see improvements here as well. So these, the entire vehicle pack remains our favored pick out here.
All right. Hi, Nishit. Good morning. Thanks so much for joining in. What about the gold financiers? They were losing some market share. Now they've come back with the increase that we have seen in gold prices, maybe moving in sympathy. But what's the trajectory from here on? Because on that high base, growth hasn't really been coming about. Your view on them and what's your preference out there?
Sure. So, see, there are two parts in gold segment. One is the lower ticket part, which is catered to by NBFCs, and larger tickets where I think you can start seeing competition from banks coming in. The larger ticket parts where there is competition from bank, I think that part remains similar. It remains as competitive as the 6 months back. The lower ticket part where there were only NBFCs, in this segment, you have seen that yields have gone up, and I think you will see improvement in margins to that extent. So are we better off than what we were, let's say, 6 months back? The answer is yes. But clearly, I think you do see competition from the banking side in the higher tickets. We have we have a coverage on Muthoot over here, and we have liked this name. Gold prices being what they are and the kind of appreciation that you have seen over the last 2 months, one is saying that this quarter should be very good in terms of loan growth. So that is the loan growth as well as margin. So that's something which works for this quarter. But frankly, you should look at steady improvements in this business unless and until, and the big turning around point would be when banking competition slows down. Our sense is that many of these new lenders who have come into the market, they have not seen a gold price down cycle. The real test will be when gold prices come down and, come down significantly in 1 quarter or so. And that's where I think the risk management systems of some of these newer players and newer competitions will be tested. And that's where we believe that the traditional gold financiers will kind of make a comeback because these companies have proven themselves through, multiple cycles.
So those who are holding on, hanging on to Muthoot, what's the recommendation, Nishant? Although before the gold prices come off, the overall consensus seems to be that gold prices perhaps drift higher even from here. The last time I think the Muthoot management was with us, which is not very long back, they said AUM growth is going to go back to 15% from what I remember. This is, I think, they were guiding for next year. So a quick one, Nishant. Hold on.
Yeah, sure. So we would clearly be, hold on. We would say that this is a good opportunity, even if you're a long-term buyer, because there is pessimism at its peak, expectation that competition is just going to sustain over here. Obviously, gold prices, kind of move through cycles. So there will be a phase in which I think some of the newer companies will put through testing time. So for a long-term buyer, I think this is a good time to really enter the stock. If you are an owner, we will continue to hold on to this for sure.
What about the other big one, Bajaj Finance? Nishant, I mean, will it, lots of questions, right? I mean, again, performance has been superb for so long and now a little subpar over the last year and a half or so. Stock performance, that is. Growth rates have also come off, to be fair. They're not what they used to be. So what's the sense there, Bajaj Finance?
Yeah, so our sense is this could be a steady compounder from here on. I won't expect re-rating in the stock, but I should say it could be a steady compounder from here on. This company has been guiding for around 25% growth, but consistently delivering 30-35. And I guess the market expected them to sort of continue to deliver 30-35% growth. When we got a sense that this year should not be that superlative kind of a growth, I think the stock corrected. From those levels, our sense is obviously you don't go down from 30% to 20% like overnight. So can this company sustain a 25% sort of a loan growth? The answer is probably yes. And you should expect a steady compounder, but don't expect a re-rating from these levels.
All right. Thanks a lot for joining in, Nishan. Appreciate your thoughts. By the way, I just wanted to mention that in the market, although the headline index may be quiet, IT is once again taking a big knock. So whether it's Infosys, HCL Tech, TCS, they've all resumed their downside. And this assumes importance because HCL Tech comes out with its numbers tomorrow. Once again, there's an expectation there will be hardly any constant currency growth for HCL Tech. The CNBC-TV18 poll has thrown up a 0.2% constant currency growth. So, the expectation is that we could be perhaps looking at another muted set of numbers.
All right. So that's HCL Tech for you, 1.6, 1.7 lower. Now, ICICI Lombard is losing on the back of what is being seen by analysts as a weak fourth quarter performance. The company saw growth in net earned premium, but still was below expectations. Their fourth quarter loss ratio has also expanded, although their profitability is above what was being expected by the street. Gopal Balachandran is Chief Financial Officer and Chief Risk Officer at ICICI Lombard General Insurance. He's joining us right now to take some questions. Gopal, good to have you with us here. Good morning. Thanks for your time. Some specifics straight off the bat, Gopal. What kind of trends did you see in the motor third-party book? If you can start there, and why is the loss ratio there gone up?
So good morning, Prashant, and good morning, everyone. So on motor third party, I think specifically, as we keep saying, you have to always look at the portfolio loss experience over longer horizons, because this particular segment exhibits very long tail of claims development running into several years. So hence, in a particular quarter, you will always find aberrations in terms of the loss experience. A better outcome is to kind of look at the loss ratio numbers more on a year-on-year basis, which if you would have seen, let's say for the year gone by, for motor third party, the loss ratio was at about 72%. In fact, this number is slightly lower than what we had seen for the last year, which was at about 74. Quarter, as I said, obviously there are multiple factors that goes into it, and hence to that extent, one should look at more on a year-on-year comparison.
All right. Hi, good morning, Gopal. Thanks so much for joining in. Well, I'm looking at your numbers, and ICICI Lombard, you all sold a large motor pool of close to around 280 crores or to a peer in February 2023, right? Now, what would have been the combined ratio if you didn't sell this?
So again, good morning, Nigel. So to my mind, as we had kind of put out, it's more a one-off transaction that we have done, and what we are explaining also in the analyst call yesterday, it does not have any kind of a material impact insofar as the combined ratio is concerned. Having said that, the transaction is definitely a commercially viable one, but in terms of the impact on the combined ratio, it does not have a material impact, even if you would not have done that particular deal.
Okay, all right. But you have been guiding that the combined ratio will come in lower. I think you were guiding for around 102% odd. How do you achieve this? Going ahead, what kind of rationalization steps will you be looking at?
Yeah, so absolutely. So again, when you look at maybe if you were to step back, maybe a year and a half back, at which point of time maybe the combined ratios, when we kind of did the integration with Bharti AXA, stood elevated at 105 on a blended basis. Even at that point of time, we had said possibly for FY23, we will look at getting to a combined which is around 104, which is what we have been able to achieve. And even at 1 year back, we had kind of spoken about by FY25, possibly to get the combined ratios down to 102%. So there are multiple levels that we kind of work with. Clearly, in terms of increase in pricing is one of the levers that we kind of largely look at. For example, on the retail health, this February, we have kind of effected a price increase of about 19% on the renewal part of the health segment. So therefore, pricing is definitely one of the levers that we have. We equally look at actively focusing a lot on claim service efficiency, because that typically forms the bulk of the combined ratio breakdown if we were to look at. And third, and more importantly, we will continue to make our investments in various areas of expanded distribution, but early signs of success of those investments translating into incremental revenues is already something that we are seeing. So hence, efficiency and operations will also be the third lever that one will look at.
Okay, so you're saying a combined ratio of 102% is what you hold on to by FY25. Got that. Can you tell us for FY24 particularly, what are you looking at in terms of a premium growth as well as on profitability? What are the numbers that you're targeting?
So again, that's a great question, Sonia, because so again, let me kind of step back. If we were to kind of look at this market, not just for the year gone by, even for the year gone by, the industry clocked about 16.4%. And for ICICI Lombard, we had a share above the market at about 17%. But even if you look at longer horizons over the last 15 years, the market has compounded at 15%. And given the opportunity that one is seeing, even in terms of the road forward, particularly when you look at, let's say, FY24 or beyond, we believe the market should continue to grow in the range of 15 to 20%. And from an ICICI Lombard standpoint, we would obviously want to see a similar kind of maybe beating the market by maybe 1 or 2 basis points over the market growth rates from a revenue perspective. On the combined ratio, as we have kind of spoken about, I think the current combined exit was closer to about 104. Directionally, we would obviously want to see a declining trend in combined even for FY24. And as we head into FY25, get to that number of 102%.
I got that. Gopal, could you confirm if so there has been this ongoing GST investigation with regards to general insurers. Could you confirm if ICICI Lombard has also received a notice?
So I think insofar as the tax matter is concerned, I think as you rightly said, across the industry, multiple players in the markets obviously has been kind of called for informations and documentation. And even from an ICICI Lombard standpoint, we have been submitting and extending the necessary cooperation that is required insofar as the tax authorities are concerned. And hence, we will obviously wait and see how things kind of further shape up on that.
Is it a tax demand, Gopal?
At this point of time, we have not necessarily received any particular demand notice. As I said, this is more currently at the stage of seeking information and documentation. And in line with what, let's say, other players in the market are also kind of exhibiting, we are also extending necessary cooperation in terms of making those information available to the tax authorities.
All right, Gopal, what's the outlook for crop insurance for FY24? That's post the acquisition of Bharti AXA. Will it be around 4 to 5% of your total business? Just give us some outlook on that vertical.
Yeah, I think, so again, Nigel, what we have been kind of talking to the market on the crop side is obviously we would want to continue to stay invested in that segment. But having said that, you're right. If you look at the overall mix of crop to our aggregate revenues has been at a single digit number. And even as we kind of head into FY24, the process is obviously to kind of see that number staying around that levels of between 4 to 5% of the overall revenues. That's the thought that we have on the side.
Okay. I also wanted to know what is the progress as far as the banker channel partners are concerned, Axis Bank, HDFC Bank, what kind of market share have you gained and what does the way forward look like?
So that's a great question, Sonia, because at the time when we kind of announced the Bharti AXA transaction, obviously one of the things that we, amongst other things that we were able to get as a part of the deal was access to a couple of large private banks, as you rightly mentioned, both Axis as well as HDFC Bank. And clearly at that point of time when we announced the deal, the market possibly had an apprehension as to these distributions will subsist with us in terms of the long-term prospect. We are extremely happy to note that we have been able to kind of subsist that even as we speak. And clearly what we have been also able to do is to increase the wallet share, which in the past used to be a single digit number in terms of contribution because Bharti AXA had got access to both Axis and HDFC very recently. And therefore they are a single digit wallet share in terms of both those distribution partners. Today, over a 2-year cycle, we have actually been able to get into a double digit market share in both of those distribution partners. So very, very excited with the way how things is playing out, particularly with respect to those bank partners that we were able to get an access to.
Gopal, now this is something we've discussed earlier as well, but now with the new expenses of management guidelines, could you tell us what is the, what's the thinking? How much can you get the EOM number down by each year? I think you were at 29.6% in FY23.
Yeah, so Prashant, so one, if you ask me directionally, again, this change in the expense of management guideline is an extremely positive development because, as you rightly mentioned, this particular regulation kind of looks at the transaction more at a company level, and the regulator has put out a threshold at 30% in terms of what you can have as expense of management. From an ICICI Lombard standpoint, consistently, not just the year gone by, but even otherwise, we have always operated within that threshold of 30%. And hence, to that extent, we are kind of quite comfortably placed. When you look at the market participants, which is public information, many players in the market are actually operating at a threshold which is more than 30. And there, in fact, the regulator has given a glide path to bring down their expense of management to less than 30%. Which we believe from an ICICI Lombard standpoint, actually an opportunity for us to possibly look at maybe increasing market presence.
Gopal, this won't affect business development in individual segments as, to kind of operate the way you want to?
So in fact, the change in the regulation is exactly that, because earlier we were actually having further sub-limits in terms of individual lines of businesses, in terms of what you could expend as expense of management. But the change in the regulation exactly is done away with sub-lines or sub-limits in terms of individual lines of businesses and give the desired flexibility which the industry has been seeking. And the regulator has rightfully responded to make sure that they will monitor the overall expense of management at a company level. Now it's for the individual companies to decide how do they want to kind of use that expense of management threshold. in terms of the various segments of businesses that they want to kind of underwrite or source.
Okay. Another question that I'm sure a lot of investors have is whether you would want to at some point enter the life insurance segment as well, which would complement your current health portfolio. Any plans of doing that?
So at this point of time, we have not thought about that, Sonia. I know that there has been a lot of conversations that has been happening in the context of a composite license. To answer your point, at this point of time, we have not thought about that. But honestly, I think we will wait for some of these developments to happen and maybe take a call at an appropriate time.
Gopal, we have sort of large conglomerates thinking and talking about entering the space. Jio is one, right? And the number of players generally also is set to go up over the next couple of years. I mean, we have the data from applications to IRDA to start a insurance business, not just general, but life as well. So competitive intensity will go up. So when earlier you said, I mean, you've got three levers. One is pricing. The first one we mentioned was pricing. How much of that is that going to be a lever going forward in what is going to be a highly competitive scenario, according to you, briefly?
I think that's a great question. So if you look at, when you look at our combined ratios, Prashant, we are, as I said, operating at a combined of 104. But if you look at the market is operating at a combined of 116 to 118%. So clearly, I think insofar as the stress that is getting exhibited on players in the market and their ability to continue to remain competitive, obviously will be put to question as we kind of look forward. Plus the fact that I mentioned that many players in the market are already operating at an expense of management greater than 30%. And there again, they will have to obviously look at bringing down their threshold to less than 30. That again by itself presents an opportunity. To your point on competition, this market has always seen a lot of entrants kind of playing out. And the current regulatory theme being to significantly drive penetration is where maybe there is a significant interest on competition as well. Over the last several years, we have seen many players entering, and therefore that is definitely a welcome step. The question is, we will have to see which product line, which geography does each of these new entrants are kind of actively looking at. If it is with respect to a particular geography or a particular product line, then therefore to that extent at a company level or maybe at an industry level across lines, we may not see so much of competition. But if it's an entrant who wants to look at multi-line, multi-presence, then we will have to wait and see how the space plays out.
Gopal, you've given us the guideline in terms of combined ratio coming down to around 102%. And as you said, it's much lower than what, currently as well, much lower than what the industry average is. What about loss ratio? Can you give us an outlook for FY24?
So, Nigel, it's a combined ratio because there are various moving parts in terms of the loss experience as well as the expense ratios, which are typically the components of the combined. And there could be different segments that will exhibit maybe higher loss ratios and lower expenses. Equally, there are segments which operate with maybe lower loss ratio and higher cost of distribution. So the way we would obviously want to transition is a mix of both. So hence, to that extent, we would not be able to specifically put out a number on the loss ratios. Having said that, historically, if you were to see, our loss ratios have kind of tended towards a band between 70 to 75%.
Okay, all right. That was a very extensive discussion. Thanks a lot, Gopal, for joining in. That's ICICI Lombard with the business and the way forward. Let's slip into a quick break. On the other side of the break, very quiet market, not too much happening, but Mitesh Thakkar will be joining in to give us some technical trades, so don't go anywhere. Stay tuned for that.
Okay, welcome back. The market's down 40 points. 17,620 is where we are at. And things are looking, a little down and out. Market breadth is also not converged fully, but the gap is reduced. 1,240 stocks are higher, and you've got about 800 stocks which are lower at this point in time. The one sector, I think, which is doing very well is metals, right? So Jindal Steel is right in the top of the list, which is up 4%. It was not there in the morning. So JSPL, the metal index is up about 1.25%. JSPL, you've got, I think, let's look at Tata Steel, Steel Authority of India, JSW Steel. I mean, that entire pack which is, I think looking quite well. Maybe the non-steel names as well, maybe Hindalco and Nalco, etc., if we're seeing similar traction. But steel, for one, is doing pretty well at this point in time. Hindalco is up about 0.75%. So that's one sector which is jumping in an otherwise kind of flattish market. Mitesh is with us with what he thinks you should do at this point in time with new trades. Mitesh, hi, morning.
Yeah. Morning, Prashant. I think you actually, just spoken about the sector I was looking at and was about to recommend some stocks from there. I think metals is the pack to focus upon. I have, in fact, 2 buy calls from that space.
Oops, okay, there's some issue with your video. Mitesh, I think there's some issue with both the video and the audio, so we'll come back to you in a bit. We have Manisha Gupta also waiting by in the studio here to tell us about the commodities that she's tracking this morning. Manisha, what do you have?
Oh, I'm extending this conversation about metals, absolutely, because we have seen strong gains overnight into this pack. The best gains clearly came in for aluminum, 2.5% of a jump up on LME there. The markets are trading firm because the US dollar has seen a bit of a decline from the kind of highs that we started this week with. And then we've spoken about the China first quarter GDP numbers, which have come in on the stronger side. The retail sales, factory activity also are some of the numbers which came positive. And then the China new car sales for the month of March on a year-on-year basis saw a jump up of nearly 10%. Not just that, the automobile numbers also have seen a positive make coming in. So the automobile output jumped up by 15.3% on a year-on-year basis. So most of these numbers really seem to be coming in on the positive side. I want to start with palladium because this is a metal that is used in automobiles, and with the numbers coming in strong, we are looking at the prices trading at a 2-month highs right now. Overnight, we've seen prices gain up by nearly 4.5%. Also, when you look at the Norilsk nickel statement, which says that the output for palladium will decline 8 to 14% on planned maintenance, is something that is supporting the prices there as well. Platinum as well is trading on a higher side here. We're looking at aluminum prices now trading at a 6-week highs. Yesterday was 2.5% of a jump up coming in, so some bit of a correction coming in on your screens right now. Copper as well is trading at a 1-month highs, and we have seen copper inventories on LME at just about 56,000, which is the lowest since 2005, and that is a sector, or that is a fact that continues to lead to buying on every dip that we have seen come in for copper. Nickel as well is trading at a 7-week highs. Here as well, the inventories have declined by 48% on a year-on-year basis. In the first quarter of this year itself, that has been a supportive factor. Take a look at zinc, and that has been an underperformer, but the last 6 or 7 trading sessions, we've seen support come in for this one as well. So trading at a 2-week highs for the zinc prices, and here as well, the LME inventories are the lowest since 1989. So fundamentals clearly continue to be supportive. Iron and steel, take a look at that, and these have been a couple of metals which haven't done well for the month of March. But at this point in time, we have iron ore, which is trading off 3-month lows. Steel as well, trading off its 4-month lows. That is where, pardon me, it was trading in the previous week there. Tin is an outperformer because the prices here are trading at an 8-week highs. We have seen prices gain up by 10% overnight after Myanmar has issued a ban on mining activities from the month of August. The report card on what the metals have done in the previous week should come in on your screen. So we have seen 6 to 10% of gains come in for platinum and palladium. 3 to 4% of a jump up is what we've seen come in for zinc and lead. 6% of gains for aluminum, and 10 to 12 or rather 15% of a jump up for nickel and tin. So clearly metals continue to be in flavor.
Okay, thanks a lot, Manisha, for that. Well, let's get back to Mitesh now. I think his audio is fixed. Mitesh, we can hear you now. Go ahead. Tell us what are your stock ideas?
I think some technical issue, but yeah. So I was talking about metals, and I have 2 buy calls over there. Steel Authority is a buy with a stop just below 82.25, just below today's low, in fact. And I would look at a target of around 87 over here. And National Aluminum, that's another metal stock on the radar. That's a buy with a stop below 82.5 for targets of around 88.
Okay, all right. Thanks a lot for that, Mitesh. By the way, the market's still very, very quiet. The Nifty Bank, that's a little off color yet again. And that's the problem pocket, because you can have the pharma, the metal stocks that do well, but they don't count for much on the index. You need the big boys. That's the Nifty Bank as well as the IT index to do well. That's what will help the Nifty move higher. For the time being, we'll still big. But on the other side, we'll connect with Mr. Lalit Agarwal, the founder and managing director of V-Mart, to discuss demand as well as how the business environment Welcome back. Well, the markets are down closer around 30 points thereabouts. Here, Bajaj Electric Vehicle changed hands. For the time being, the stock is reacting positively, up closer around 2%. Recently told us that they should see better sales from Q1 FY24. Mr. Lalit Agarwal, the founder and managing director at V-Mart, joins us on the show. Hi, Mr. Agarwal. Good morning. Thanks so much for joining in. Are you seeing some signs of some slowdown?
Yeah, there is definitely a roller coaster ride which is going.
Hey,
Oopsie daisy.
Seems to be a roller coaster ride with the technology as well today. Nothing seems to be working out, but I guess that it's just one of those days. We'll try and connect back with V-Mart in a bit. Just want to mention a couple of stocks. It's really the day that belongs to metals today. So Tata Steel is your top Nifty gainer, followed by JSW Steel, Hindalco, all big movers at the moment. Even in the broader markets, actually, the metal stocks are doing pretty well. So we'll get to that in a bit. But I think Mr. Lalit is back with us. So you were telling us that it's a roller coaster ride. Are you referring to the fact that perhaps demand has not recovered as much as what you would have expected?
Yeah, I mean, definitely it has not recovered the way we would have expected and the way market should have, because there are also, they are Indian, and especially the Bharat calendar moves a little more on the Hindu calendar side. And then because of that, there are some non-auspicious days which also result into non-marriages and no marriages in the particular month. So I think those are some of the pieces which are affecting the demand as well. So we are seeing some demand coming back, but still not to the expectation that we would want it to be.
Okay, so demand is not coming back to the expectation that you would want it to be. But can you give us some numbers? I think in the 9 months of this year, your revenues were around 1,900 crores or so. On the back of that, what kind of growth can you put in? Are you looking at a single-digit growth? Can you manage double digits in FY24?
In the FY22, we are looking at single-digit growth only. We are not expecting too much because definitely there are not too healthy signs coming in from the market, in the consumer market. So there will be a higher single digit is what we are expecting, and we believe that is what we should be able to drive.
Right, Mr. Agarwal, just to press on that point and not to be too specific, but right, I mean, I'm just looking at two numbers here for you, right? EBITDA growth, EBITDA CAGR growth between FY17 to FY20 was some 16% for you. From FY20 to FY23, that number is minus 0.7%. So it's been very stark. What should we really expect? I mean, will you have to change strategy? Is it just a cyclical kind of slowdown and things will pick up? What will cause that change for you? Change higher, change for the better?
Prashant, I'm not trying to react on the EBITDA piece right now because we are on the closing side. But right now, I mean, I just understand that there is definitely a demand issue in our markets. There are also competitive landscape which is also intensifying in this particular space. So overall, the kind of growth that we would look at from the pre-COVID level is still not there in the air, and then that's what is also creating some kind of pressure on the margins. But yeah. I'm not looking at margins right now, but I'm looking at the revenues and then looking at the same store sales growth, which is very, very important. And that's what our focus is. How do we bring back those customers and those basic, lower per capita income demographic customer who have been impacted by the inflation? How do we bring back them into the consuming space? And if they start consuming back in the manner that they used to, it would certainly come back. So, and there are issues right now, especially in the hinterlands and especially in the smaller towns. We are seeing definitely a lot of formalization of economy which is happening, but definitely there is also pressure which is getting built right now. There are not too many jobs which are getting created, but still, the farmer is earning up to its capabilities and up to the potentiality that they could. So I think if we look at this monsoon, and if this monsoon becomes good, we should see a lot of confidence coming back to the consumer. If the confidence of the consumer comes back, it's more about the feel-good factor, so that they can actually put their money behind and invest on their consumption, not invest on the savings.
I've got that. If I just, so you said you'll focus on revenues and not down the line. If I look at the same, the revenue metric for the same two periods, 17 to 20 and then 20 to 23, It was 18.4% in the pre-COVID, and it is now 14% revenue CAGR. So what should we? You said you were expecting single-digit kind of growth, right? You also throw in competition, much higher competition now in the segments and the cities that you operate in. So talk to us a little bit about that. So single-digit is the way to go for the foreseeable future. And second, talk to us a little bit about competition in your segments. Some qualitative aspects, sir.
So single digit, when we say single digit, it is more about like for like sales, where the stores which were existing for 365 days in the last year would have single digit kind of growth is what we are expecting. We don't really want to bring out those numbers, because we will definitely be adding more stores in our kitty, and then we have our expansion plan. We opened up 59 stores last year, and we will be opening more than 59 this year as well. So there'll be growth coming in, which we call as inorganic, but not purely organic. But yeah, that there'll be some growth coming in from there as well. And I think competition definitely in this value fashion space, there is a lot of player which is coming. The density in the market of the number of retail stores, as well as the amount of online media which is available, has almost doubled up in the last 1 year. So I think there is definitely more players walking into this particular field, either from the national competitors or from the regional competitors, as well as the online mode. We have seen a lot of growth coming in.
Okay, so you said you're going to add about more than 59 stores in this full year. I think in 9 months of this year, you added 36 stores already. So can we assume that in the last quarter, there's about 23 stores that you're expecting to add, or in 23, 25 stores? And what about the store addition in FY24? What are we looking at?
We have added almost 59 stores altogether in this particular year, but we have also closed 15 non-performing stores in this particular year as well. In the new this fiscal, I think we are targeting more than the number of stores that we have opened in the last year. Is that what we are looking at? And it should be ranging between around 65 to 68.
Okay. And what would the expansion plans look like, both organic and inorganic? I mean, what are the cash on the books and any more acquisitions? I'm asking because, this is the time when there's a lot of competition entering the space, like you just mentioned. So what would the growth plans look like, both organic and inorganic?
No, Sonia, we are completely going organic, and we definitely only want to focus on our strength, which we have. And we have already entered into the southern market in India through Unlimited. And now we want to expand both the territories, and northern as well as southern. And we continue to expand towards the eastern side as well. So I think we have our own plans, and we will just keep growing those stores, and which are doing great. And we have added more stores also in those Unlimited territories as well as VMart territories in the last year. We continue to do in the current year as well.
Okay, we leave it at that. Mr. Agarwal, thanks a lot for joining in. All the best. That's VMart, by the way, talking about the scope going forward. They're saying rural market has not really recovered as much as one would have expected. In FY24, they are looking at best a single-digit growth in the full year. But they're adding some new stores as well. There's a lot of competition kicking through in this space. So that's something that, keeps them a bit cautious. But let's get back to the market. In the last few days, the pharma space has been buzzing quite a bit. Ekta is here to tell us why she's tracking Piramal Pharma and Glenmark Pharma. Ekta, over to you.
Thanks for that. Well, I'll start with Glenmark because that stock is in focus on the back of a bit of news. So Zetia is basically a drug which is used for the treatment of cholesterol. And what has taken place is that in a pending antitrust and consumer protection litigation in the US on Zetia generic, Glenmark was named as a defendant. So what has taken place is that the company has agreed to enter a settlement with a group, with a party which was litigating against Glenmark on Zetia generic. As per the settlement, the company is going to pay $48 billion to direct purchasers, which is basically the group which is a part of this litigation, based on the agreement entered. The trial, remember, for this case was scheduled to begin on April 19th. In the US courts. Now, just to give you a bit of a background as well, there have been multiple lawsuits in the US in connection with generic Zetia all the way since 2010. Lawsuits allege that the company had entered into an anti-competitive agreement. So there was a pending lawsuit with regards to Zetia generic, which is now settled, and the company is going to be paying $48 million in terms of the settlement. It does come as a positive because there's an overhang which is out of the way, and this is a generally a normal course of business for most pharma companies. Remember, the amount which we've spoken of is not that large in terms of a sum, so hence maybe the street has brushed it off. Glenmark is anyway close to a 52-week high. Piramal Pharma is in focus because the US FDA has concluded the inspection of the company's Sellersville manufacturing facility. They've issued an establishment inspection report, which means that the inspection has concluded successfully. Now, this is important because this has been one of the USPs for Piramal Pharma, that they have an excellent track record when it comes to the US FDA. They, in fact, have closed all 4 US FDA inspections since November 2022 successfully, which includes the Digwal facility, Riverview, Lexington, and now Sellersville. So this is definitely a positive for Piramal Pharma. Remember, the stock is also corrected very significantly from that listing price of around 200 rupees odd last year. And maybe there is some amount of value buying that the street is recognizing with regards to their track record.
Okay, thanks a lot for that. So that's on Piramal Pharma, but just wanted to wrap up the show, and as we do that, just a couple of more thoughts on the market. Very, very quiet as we wrap up the first hour and a half of trade. I mean, it's almost as though nothing has happened, right? Headline index is holding up, but one thing that stands out is that IT is under pressure, and metals is something that's looking pretty good. So those are a couple of sectoral trends. That
lots of stocks also. Zomato was not there in the mix in the morning. Zomato is suddenly at the top of the board in terms of volume-led gainers. The stock should come up on your screen. It's up 3.5%. Shilpa Medicare, I'm not sure if there's any news flow, but the stock's up 6.5%. And on very large volumes for this time of the day on that name, Sequent Scientific is up 7%. Sequent Scientific, again, very large volumes. Sonata Software, so there's mid-cap, smaller, not even mid-cap, but smaller IT companies. Sonata is up about 4.5%. Again, large volumes, and that's why I'm mentioning it. Lemon Tree is up about 3.25%. Uflex is up 5%. South Indian Bank is up 4%. So lots of new names. Mirza International, if you can pull that up. Mirza International is up 11% on decent sized volumes. Godfrey Phillips is up 4%. Suddenly, it's getting interesting. The mix is getting interesting with lots of new names which are starting to move higher and moving higher on fair bit of volumes as well. So that's the market for you. On the index, still nothing, 30 points lower, 17,600 or so is where we're at. It's a wrap from all of us here. Thank you very much for staying with us over the last 2.5 hours. Chartbusters will come up in just a bit.